Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Interest rates take cues from several places. Regularly scheduled economic data is always a consideration because a stronger economy implies more growth and tighter Fed policy, both of which are bad for rates. Certain reports carry significantly more weight than others. And if put to a vote, the top dog of reports would be the employment situation, aka the jobs report. As I've said in the past videos, 2022 was all about inflation. 2023 will be all about the jobs and the wage growth. Friday's report actually proved me correct. Over the years, it's responsible for more volume and volatility in rates than any other data. Most recent installment came out Friday, and it was a doozy. The headline number of the jobs report is a tally of the new job creation reported by employers, non-farm payrolls. That's just a fancy name for jobs. Friday's data reported the new jobs added in January, and there were quite a bit more added than expected. NFP came in fairly volatile. This is not uncommon to see the number deviate from the forecast by more than 100,000 a few times a year. Those big deviations usually result in big reactions in rates. Forecasts called for just shy of 200,000 jobs. Friday's actual NFP number came in at a staggering 517,000, thus edging out March 2022 to stand as the biggest deviation since August of 2021. To some extent, the massive gains may be attributed to a seasonally adjusted process that still struggles to understand new seasonal patterns that emerged after the pandemic. But even if I forego seasonal adjustments, the economy added more than 400,000 jobs per month on average over the past 12 months, and the employment rate has fallen to the lowest level since the 1960s. Although this all sounds good, this doesn't account for the second part of my equation, wage growth. And that has been slowly but surely eroded by inflation. Actual purchasing power is down year over year. In other words, despite anecdotes that speak to the cracks in the economy, the most highly regarded measure of employment says things are super strong. Super strong jobs numbers are bad for rates, and these were no exception. Fortunately, the damage arrived one day after the lowest rates in more than 4 months. This keeps rate volatility lower in the bigger picture. You may notice the small jump at the very end of the blue line in the previous chart. That was the impact from the jobs report. Mortgage rates only change once or twice a day at most. So you examine the week on a more granular level by looking at the 10-year Treasury yields, which correlate quite well with mortgage rates. The next chart shows recent movement in the 10-year yields, both for the US and the EU. Europe's central bank released a policy announcement this week, one day after the Fed released its own policy announcement. Both banks hiked rates as expected, but both delivered comments that the bond market found to be more rate-friendly than expected. That's why U.S. yields fell on Wednesday afternoon after the Fed and the EU yields fell on Thursday morning after the ECB. Despite the volatility in the short term, the bigger picture is much calmer than it had been in late 2022. In fact, rates have generally been settling down and shifting into a sideways pattern ever since topping out in the fall. If inflation continues to decelerate, and if the economy were to weaken, rates will likely continue lower. But if we see more data like we saw today or last Friday, that progress would be delayed. Now, in other news this week, home price indices were updated for both the S&P Case-Shiller and the FHFA. Prices continue to decline nationally, roughly in line with expectations in month-over-month terms, but remain higher than normal in annual terms. Now, keep in mind, values are regional and break down even by neighborhood, and not all neighborhoods are created equal. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.